Hello and welcome everyone. Here for another educational presentation from Bayntree Wealth Advisors. My name is John Jangle, Senior Financial Advisor here at Bayntree. Today we are going to talk about some of the common ways that you can access funds from your 401k and some rollover options. And if you don't know what a rollover is, we'll get into that a little bit too. But before we do, quick disclosure. This presentation is purely for educational purposes, so don't base any of your decision-making off of what we're talking about or construe this as advice. Be sure to talk to your own financial planner, tax professional, when you're trying to make any of these types of decisions with accessing funds from your own 401k. So we're going to really look at the most common ways that an individual may access funds from their employer-sponsored retirement plan, 401k, 403b, if you work for a nonprofit. There are some other ways, less common ways, but today we really want to focus on kind of the general ways in which a participant is going to access those funds. So most common, and one that we see the most, is separation from service. So what does that mean? It's either maybe you were laid off, you decided to take a different job, or you're just looking for a new path in life and you're trying to decide what to do with those funds. So separation from service, however that comes about, you then do have some options with your 401k plan. Now, you could take out that money. You could take a lump sum of your accrued balance. Generally not a good idea, especially if you have a large pre-tax balance in that plan. That is fully taxable as ordinary income, state and federal, from a tax standpoint, so it can push you up into another tax bracket. There's also pre-distribution penalties if you're under age 59 and a half. So a lot of tax considerations to consider if you're thinking of actually taking money out and putting it in your pocket when you separate for service. So more commonly, especially if somebody is still working, and even when somebody does retire, is what's called a rollover. And a rollover is a non-taxable transaction in which you take this group plan, this employer-sponsored plan in a 401k, and you move it over into your own individual retirement account, what's called an IRA. Now, you may have Roth money as well as traditional money. If you were to do a rollover, you'd have to have two separate accounts, one a traditional IRA, one a Roth IRA, and then those funds are directed from your custodian into those new accounts. Another way in which individuals, which is similar to a separation from service, in which individuals are going to access funds in their 401k, is via retirement. So you've worked, you've accumulated your assets, you have a solid retirement plan in place, and you decide, I'm going to retire, I'm going to maybe roll over those funds. You can leave the funds in the 401k as well. And I'm going to start taking distributions. Again, if you're taking any pre-tax distributions, those will be taxed, whatever the current federal and state income taxes are, and also will be combined in with all of your other income sources as well. So you want to have when you retire, a solid distribution plan to make sure you're able to supplement your income in retirement. Another way, maybe less common, that individuals can access funds from their 401k is via disability, and that is the Social Security definition of disability. So there are provisions to make sure if somebody really comes into a bind, if they have medical issues, if they become disabled, that they have access to that capital that they've accrued within their 401k plan to help cover their living costs as well. So not as common as the first 2 points that we were talking about, but definitely something if you are in a situation where you have a loved one who may be disabled and you're looking at, okay, how can I fund my lifestyle moving forward? You're going to want to look at all aspects, and the 401k can play into that. Another way, sort of similar to disability, but a little bit different, is a hardship distribution. So plans will allow a hardship distribution if you're in a financial position where you can't pay your bills, you need to take distribution, really a last ditch effort, if you will, kind of last resort. Really, a 401k plan is intended to be set up to fund your retirement. But again, you want to have some flexibility there if you've knocked off everything else that you can in terms of covering some hardship expenses, maybe really big medical costs, the 401k can be accessed there for those hardship distributions. And then probably the least fun one, but very important matter to discuss is if you were to pass and leaving those funds to a beneficiary. So if you as a participant or you know somebody who has passed and has a 401k plan, you really want to ensure that you have your beneficiary designation correct. So if you live in a community property state like Arizona or California, your spouse, if you're married, is required to be your primary beneficiary unless they sign off on that and allow you to appoint somebody else. Probably a pretty rare occurrence, but never say never. So it's really important every year to check your beneficiary designation, especially if you're moving employers, if you are doing rollovers. You want to make sure that that's set up correctly, because the custodian who actually holds the account, they are going to base who those funds go to solely off of that beneficiary designation. So you want to really eliminate any confusion of who's to get the money if something were to happen to you. Now, there are different tax ramifications too when a beneficiary assumes 401k or retirement funds. So that's something very important to discuss with your financial advisor too. Understanding the tax ramifications of any of these distributions is very important and can help inform your decisions when integrating your 401k with your overall financial plan. As always, that is one thing that we really want to focus on: taxes, 401k distributions. So again, there are some exceptions. We're not necessarily today talking about these exceptions because they are less common. But as I stated before, any distribution taken out, taxes, ordinary income, state and federal. If you do have Roth money in there and you've satisfied certain timelines, certain age requirements, you can actually withdraw those funds tax-free. So again, to reiterate, the difference between a traditional 401k and a Roth: traditional 401k, money goes in, you get a tax deduction, meaning you're not paying taxes on that money today. When you take a distribution, you will pay taxes at whatever amount you take out and wherever tax rates are in the future. With the Roth, it's the opposite in that you are not getting a tax deduction for funding that account. So you are still paying income taxes on that money, even though you're not pocketing it. And then in the future, when you go to distribute that money, it is tax-free. So there's pros and cons to both, and it is dependent on your own situation. Just don't make any hasty decisions when you're trying to decide if you're going to take money out of your 401k. There are a lot of ramifications from a tax standpoint, or potentially could be. We are here to discuss any of those planning points with you. If you need an evaluation on your plan, if you need to know certain plan provisions on what your plan allows as far as distributions, give us a call. We can dig in with you. We're here to help. Happy planning to everyone out there, and looking forward to seeing you again very soon. Take care.